Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. Headache time again. Yes, it's that time, though getting less each week. I must apologize once more for the multitude of lines and labels that I've drawn and have kept on this daily chart. However, technically there's still much going on here, and these labels and lines are all valid in my deciphering and trying to decipher what is happening here. Okay, so instead of giving a huge history of all this, I will instead talk about the action from the peak in May and reference earlier pieces as I deem necessary. The market's peak in May was at the neckline of the August to November 2021 complex triple top, currently at 2056, breaching it ever so slightly before the rally failed and we saw prices drop, gapping lower. The massive congestion support we've seen around the middle time at the time of the December 2020 to April 2021 bullish shift pitchfork is currently at 1936. Mainly was the combination of the February 21 high at 1894, the medium moving average currently at 1912, the long moving average currently 1910, and the short medium moving average currently 1898. Well, they eroded the bearishness on the way down from the start of May until the middle of the month, such that though prices pushed further down below all of them, the market did not have the immediate energy to aggressively push too much lower. For instance, we did have support below this congestion with another congestion area dating from February this year between approximately 1840 to 18 even. 2 weeks ago, the market tested down and through this area, all the way down to breach the lower time, currently at 1777, the recent April to May bearish shift pitchfork. Yet the market did not break it, as the fall only extended down to the 50% Fibonacci line of the March to November 21 move at 1768, before prices turned back up again. This 50% Fibonacci line has been very influential, as it has stopped declines earlier in January, February, and March as well. These two supports, the declining lower time and the 50% Fibonacci line, turn prices back up with such vehemence that by today prices are over all of the moving averages, as well as the middle time of the December 20 to April 2021 bullish shift pitchfork, 22 even bullish shift pitchfork, and moving up to test the upper time of the recent April to May bearish shift pitchfork. Thus, we have seen dramatic moves up over both bearish and bullish patterns that occupy this daily chart, but just in different time references. Now, 2 weeks ago, the market made a weekly key reversal up. Today, we came ever so close to setting up the conditions for a monthly key reversal up, possibly. Price is actually needed, and they still need, to exceed 1968 by Friday the 30th of July. I think we got to 1959 today. And then they need to close over 1940, which if you get up to 69 or onwards, you probably will do close. Now, both these things are eminently doable, and this ties in my final comments from last week, and I quote, "So, at the same time, the bigger picture is slowly rising bullish shift pitchfork, whilst the more recent move is a bounce up within a much smaller bearish shift pitchfork. Such a situation cannot last. One of these two will have to give. And at the moment, it seems the top side's going to be tested for the bearish shift pitchfork." Ice Europe white sugar in London. The rise we saw late May going into June starting to be corralled on the top side for the most part by the middle time, currently at 6:15 even. Actually 6:15.10 of the February to May breach and now broken bullish Andrews pitchfork. The rest of the heavy work of resistance was made up by the upper time, currently 6:11.20 of the bullish shift pitchfork for the same move as the bullish Andrews pitchfork. Remember these two pitchfork tines, as they will come up again later on. There were also banded resistances that helped cap the rise, starting at 587.10 all the way up to 608.30, and included the November 2016 high at 590 even, and the October 2016 high at 608.30. This congestion was too much for the bullish incentive at that time, and in early June the market made a weekly key reversal down in response. This led to a period of indecision between roughly 555 even and 570 even, ending towards late June, before dropping down through the base of the congestion as well as the middle tine. And that's currently at 572.5. And that's of the shallower bullish shift pitch fork. And that's for the same move as the bullish Andrews one. There was a carry on down through the lower tine, currently at 569.70, of the more acute bullish Andrews pitch fork, and trying to push down and test the rising medium moving average below, currently 546.20, but not managing it, just holding to the broken lower tine. This holding close, the holding close was prompted by the short medium moving average, currently at 555.70, which curved the market back up last week. However, the spark that caused the rally late last week was ignited last Monday, the 11th, and it was something I'd cautioned about. You see, and I quote, "Now, what I would like you to note are the two round circles on the daily chart. They indicate two dates when the tines of the bullish Andrews and shift pitch forks cross over. The first is partially obscured, but is also today, and that was last Monday. The second is on Friday, the 22nd, so that's this coming Friday. Now, what to expect? Well, look for one or more of the following possible actions: volatility, a change in trend, and or a reinforcement of a trend. This usually happens when the tines cross over or soon thereafter, hence the circles that I've marked on there, the red circles, and the caution. I suppose this goes some way to explaining the wide range we've seen today. It nevertheless gives notice of another potential volatile day about 2 weeks hence. So that's talking about the previous Monday and the move in 2 weeks' time. End of quote. So that was what was happening and what may well happen. I'll now do one glaring detail that is obvious on the daily chart. That's the changeover gap. Now, I use continuous daily charts here, and that results in gaps on my daily chart. This one here happens to be one of the larger ones I've seen. Okay? Rather than going into why I should or shouldn't use continuous charts, please just accept that I do, and that we will therefore have occasional gaps. In this case, the market has gapped down below the lower tine of the bullish Andrews pitch fork, yet still remains within the bullish shift pitch fork. Now, gaps have a tendency to be filled, even ones in continuous chart. But for the moment, the bullish Andrews pitch fork here will be retired, and after this commentary. However, I may draw a new acute bullish May to June shift pitch fork, depending on what happens. And that may also happen after this commentary. Sugar white premium spread. A huge weekly bullish engulfing pattern last week after the previous session's high but indecisive spinning top, but with the highest high and high close since 2011. This was further support for the idea of the June 21 to May 22 bullish ascending wedge pattern. However, the rise was getting up into some rarefied atmosphere. You see, prices had already reached the primary target for this pattern a few weeks ago. What was left was the harder to reach target X1 for this pattern, higher up in the 191.5 area. This target has proved to be harder to reach, as after changeover in London, prices are now below the middle tine, currently 141.25, of the only pattern that is still operational. The only pattern still standing, and that's the 2019 to 2021 bullish Andrews pitch fork. Prices this week opened on the June 2020 high at 134.25, but have been capped by the short medium moving average, currently 138.25, and we've seen prices drop below both and down towards the rising medium moving average, currently 122 even. So for such a strong realignment as we have had seen this past week, you'd think that perhaps I would also realign my commentary. Well, the answer to that is no, at least not yet. I would refer you to my comments from a few weeks ago, which I've repeated at the end of every commentary since, and I quote, "I know that these are humongously big asks, but that is what I see. It depends on one thing, and one thing only. The prices maintain contact with the middle time or break upwards clear of it. Well, so far prices have tried breaking higher but have failed to do so to reach target X1. However, the market, though gapping lower, has not as yet completely lost touch with its middle time. Only if that happens, when we properly lose contact with the middle time, then it would be appropriate to maybe, and I say maybe, retire the harder reach topside target at X1. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investors International Limited. And here comes the final bit.